But it's not just taxes. This podcast episode is about taxes. But when you are a business owner, you also have to keep in mind that if you decide to lower your business income from a taxable perspective to the lowest dollar that it could possibly be lowered, you're potentially setting yourself up to have a negative consequence for other things that you want to do in your financial life. There's a phrase that we use in the tax and the financial world that says, don't let the tax tail wag the dog. Basically saying, don't let taxes be the thing that explains and justifies all of your decisions. This is an example of that. So for example, if you are trying to get financing for your business, where you're trying to qualify for a small business loan or a line of credit that could help you make payroll or finance an expansion, part of what a banker or a lender is going to look at are your tax returns for the last 2 or 3 years. And if you're not showing a progression in revenue or any taxable revenue at all from that business, you're making it harder for yourself to qualify for that business financing, if not impossible, even though from a tax perspective, it was something that had a benefit. There are times when you have to have an idea, and we're going to talk about this in the next episode, of what's coming in the years ahead. This is also true when you're trying to do things like not just investment real estate, but even qualifying for your primary residence. This is not the same of all banks, but a consistent process that you'll find when it comes to a business owner or an entrepreneur trying to get financing for a mortgage is that your bank is going to ask for your last 2 years' tax returns as a business owner. They're going to then look at your net business income. And as much as this sucks, what many lenders will do is if there's an increase in business income from one year to the next, let's say that you went in year one from $100,000 of net business income, and in year two, you had 150,000, they are not going to give you credit for the 150,000. They're going to take the average of the 2 years, and they're going to assume that your net business income on average is 125,000. Conversely, if you have a decrease in net business income from year to year, let's say that in year one, you made 150,000 and in year two, it goes down to 100,000, maybe not because you truly had a worse year, but maybe because you utilize more business deductions and things of that nature. They don't give you the average. They take the lower of the two numbers. So instead of using 125,000, they're now using 100,000, which could make a significant difference in terms of the amount of home for which you're eligible. So even though it's important to have your eye on the ball for all of the business expenses that you could use as a deduction, you want to make sure that this is part of a comprehensive strategy, which is part of the benefit of having a CPA or an enrolled agent that works in concert with people like your financial advisors and your lenders to make sure that you're not shooting yourself in the foot because of a tax strategy that you put in place without thinking about the past and also what it means in the future when it comes to the totality of your finances.